Good afternoon and welcome to our webinar on Do you know what your company is really worth? This webinar will last about 40 minutes or so, followed by an opportunity to ask any questions. I'm Andrew Coates, I'm one of the directors of Strategic Corporate Finance. I think you've probably had a warning on your screen letting us know we're recording this webinar. We record it so we can put it on YouTube later for anybody who misses it. What we're recording is just the slides and the presenters. There's no information on the recording about the attendees or questions that get asked and who asks. The questions that get asked will be read out, but there's no information to identify attendees to the webinar. So what we're going to cover this afternoon, I'm going to give a very short introduction to who we are and why we're qualified to talk about share valuations, business valuations. And then we're going to cover the other headings on that slide. Finishing with just a very short one slide on how we can help. And then, as I say, questions at the end. So please feel free to ask questions as we go along using the Q&A button on your Zoom, on this Zoom webinar. The Q&A button sometimes appears on the top or the bottom or the side, depending on how you're viewing the webinar, but use the Q&A button and we'll pick up the questions at the end when Catherine Gordon, one of my colleagues, will join us to host the Q&A session. So just a very short introduction to Strategic Corporate Finance for those who don't know us. We're in our 22nd year and we act full-time for clients who are buying and selling businesses. So most of our work is transactional work, taking a client who often will have never been through a transaction in their life before, taking them through a sale of their company, or an acquisition of another business or a management buyout. We believe in giving a lot of early stage advice that clients embark on something that can be delivered. So as part of that early stage advice, we regularly, and by regularly I mean 3 or 4 a month, do valuation reports. And our valuation reports are very user-friendly, written in non-technical jargon, and give our comments and thoughts and what we see as strong in the business that's driving its value, the things that are draining values, all the calculations and methodology, so that a client can fully understand how someone looking at their business is likely to value it and the sort of valuation they're likely to place on it. We do quite a lot of feasibility reports as well, in terms of trade sale feasibility reports, which involve evaluation, but an assessment of current deal activity in their sector. For clients looking to carry out a management buyout or sell to a management buyout team, we'll do an MBO feasibility report, which talks about valuation again, how much will be paid at completion, how much will need to be paid on deferred terms, what funding is likely to be available. And really all this early stage advice is intended to give clients the benefit of our experience, so they know what can be achieved, what is achievable, rather than embarking on something that can never be achieved, embarking on a transaction that can be achieved. And if that transaction at that stage doesn't look the way it needs to for the client, then there's work to be done in terms of building the value first. So it's an important first tool evaluation before proceeding with a transaction. Our main services are taking clients through a transaction. And if that's a sale of a business to a trade buyer, it's doing detailed research to identify potential buyers. And we use powerful subscription databases that allow us to identify buyers, not just in the UK, but identify buyers worldwide. For clients looking to do acquisitions, the similar big database tools allow us to identify target companies that meets a client's criteria in terms of what they're looking to achieve through an acquisition. For management buyouts, it's about structuring the deal in a way that can be funded and achieving the funding. But in all cases, it's staying with the client throughout the transaction, giving the benefit of our experience and advice, doing a lot of the heavy lifting in terms of what needs to be done, so the client can concentrate on running the business and making sure the business still continues to perform. But project managing the deal and working with the clients and advising all the way through to getting it over the line at the end. And not getting it over the line at any cost, getting it over the line where that's right for the client. We've completed well over 100 transactions. Many are on this slide, but we've done many since we prepared this slide that aren't on the slide yet. We're finding deal activity really buoyant at the moment, and for the businesses we're selling, we're finding a lot of interest. And really for the last 12, 14, 15 months, we found market conditions to be very buoyant. Following the first COVID lockdown, coming back after that, deal activity picked up very quickly and has continued at quite high levels. And we're getting a lot of interest in businesses we're selling, and we're achieving very good values, often above the values we were anticipating, which is quite unusual conditions. Those thumbnails on this slide show many transactions we have completed. The same thumbnails appear on our websites and can be clicked on the website. So if there's any of those that stand out that you want to know more about, just go to our website, click on the photo, and it'll tell you more about those transactions. So that's the background as to why we are have the experience to talk about share valuations, company valuations. We've been going, as I say, 22 years. We've completed a lot of transactions. For the transactions we've completed, we've had multiple offers on the businesses we're selling. So we get a very good feel for how buyers go about valuing businesses. And we're going to share some of the benefits of that experience with you this afternoon. A fairly obvious question, why is valuation important? I'm not looking to sell for several years. Why do I need a valuation now? Why is a valuation important? For most business owners, their company will be their most valuable asset. They'll have more of their wealth invested in their own business, their own company, than in other savings, investments, and pensions. So it's a really important asset. And to leave it to finding out what your company is worth when you go through a marketing and sale process at the end and see what offers you've got is not the way to do it for something that's so valuable. You need to understand how people will value your business, what value they'll place on it, which gives you then opportunities as to what you can do to improve the value and marketability of your business in the run up to thinking about selling your business. So having a clear understanding as to how somebody will approach the methodology of valuing your business, what will be important to them, what they'll look at, what factors they will consider, gives you an insight into what to do when you're taking key business decisions over the next few years. You can have an insight into how those business decisions could affect the valuation and marketability of your business. So it gives you a clearer way of taking decisions and understanding the impact. It also helps you avoid costly mistakes. You should never initiate a sale process and get into a sale process and start getting offers without having a really good understanding as to where those offers are likely to be, what your business is worth. You shouldn't start a sales process with unrealistic price expectations, because that is a really difficult position to be in. It's a massive mindset change to decide, you've been running your business, building it up for often 20 to 30 years, and the mindset change is letting somebody take that off your hands and letting go of it and selling it is quite a difficult mindset. And if that mindset has been made on the basis you think you're going to get £3 million and you've planned your life post business based on the fact you're going to get £3 million, and you've taken the decision based on it's worth going for that figure, and you then find your business is only worth £1 million, you find yourself in a very difficult position, because you've consciously made up your mind that you do want to sell and retire. But the value is way off where it needs to be to allow you to do what you want to do the rest of your lives. So having unrealistic price expectations is a really difficult and dangerous place to be. We do find some of the national brokers and some of the smaller brokers tend to massively overvalue businesses on the basis it's a sales technique. If they, massively overvalue the business, the client thinks, wow, gosh, these people really see the value in my business, and I'll appoint them to act for me through a sales process. But that's a very difficult position, because you get stuck. The value is unachievable. So if it looks what I'm saying is, if it looks too good to be true, get a second opinion. If it doesn't, if it just looks too good to be true, get a second opinion. Having not understanding the valuation of your business, how it will be valued, can be an issue if you're getting offers as you go along. People will approach you once you get to, certainly for majority shareholders over the age of 50, with businesses with even fairly modest profitability and net assets, they'll start getting approaches. And sometimes those approaches can provide very good value, but you need to understand what your business is worth what the company is worth to be able to recognise it is good value. We've seen issues fairly recently with share options being share options causing massive problems because they've been issued on the misunderstanding of what the company is likely to be worth, and we've seen them being demotivating for the managers who've been given share options, because they suddenly find they can't meet the conditions to exercise their options on a sale, because there was a minimum sales value before they got any value out. And what's something supposed to have motivated managers and motivated to keep running the business for the new buyers become demotivating. We've also seen real issues with minority shareholders being bought out at ridiculously high valuations, debt taken on to finance that buying out of minority shareholders. And then the majority shareholder wants to sell and finds that the amount of debt taken on is he's well overpaid for the minority shareholdings, and the debt is reducing what his shares are worth to, something that's not in proportion at all to with what the minority shareholder got paid. So having a valuation, understanding the valuation is really important. Why evaluation is difficult? There's a lot of judgment goes into evaluation on SME companies. And anyone valuing a business is making certain judgment calls, and we'll cover some of those this afternoon. But there aren't lookup tables, there aren't comparable data. For listed companies, there's all sorts of data published, and you can compare listed company data. But for private companies, there are one or two organisations who try to put together data, but we find it grossly misleading. And it's misleading for several reasons. One, you don't know what the report, they're basing it on what they think. Most private company deals will be confidential. It'll be part of the share purchase agreement that the terms of the deal are not to be disclosed. You can often pick up the value of a deal a couple of years later by looking at the purchasing company's accounts and looking at the investment note. But what you can never pick up is what is the underlying true profitability. And we'll talk about underlying profitability in a few minutes' time. But the reported profitability often is very different to the underlying profitability that will continue to accrue for a buyer. And an example is directors' emoluments. Most directors of private companies will draw a salary of £8,000, £9,000 a year, and the rest by dividends. Well, the dividends don't come off the reported profitability, on which people trying to put lookup tables together are using. You need to understand the business and its risks and its prospects. That's an important part of evaluation. And there's a lot of judgment. So you may occasionally see lookup tables purporting to give you ideas for valuing it, or you can even get websites that will value your business in about 30 seconds. They're just not worth the paper they're written on. There's so much judgment needed, and we'll talk about some of the reasons for that over the next few slides. The starting point for most companies, not all, but the starting point for most companies is to do a valuation based on a multiple of profits. And the profits we're talking about are earnings before interest and tax, EBIT, or operating profit, and can be earnings before interest, tax, depreciation and amortization, EBITDA. We don't tend to use, if it's a capital intensive business such as a road haulage business, we wouldn't use EBITDA because it ignores the ongoing capital need to replace vehicles in that case. But EBITDA is commonly used, but usually used when depreciation is quite a low figure. So we're using EBIT or EBITDA and applying a multiple, and that's the starting point for most valuations. There are plenty of exceptions. I think with valuation, there's norms, and then there's exceptions, and there's plenty of exceptions on valuations. So in some sectors, some industries, valuations are based on a multiple of recurring revenues. Occasionally, the net asset value may be relevant, particularly in businesses that aren't performing, where the profitability times a multiple valuation comes in at a lot less than the net asset value. That net asset value may become relevant depending on how easy it is to realize those assets. And occasionally, and theoretically, you often tell the discounted cash flow is the best method of doing evaluation, but in practice in the SME sector, it's not used at all. It tends to be very susceptible, the discounted cash flow, to very tiny changes in some of the assumptions you make. So it isn't commonly used. The common method for most businesses, and I'd say 80% plus businesses, is to take a multiple of EBIT or EBITDA. So that's what we're looking at here. So we take the underlying profit, and I'll talk on the next slide as to what underlying profit means, and we apply an earnings multiple. And this works for businesses that have been going some time, mature businesses, profitable businesses. It's easiest to apply where business is nice and consistent, where the profits are consistently flat or consistently increasing slightly. But it can apply to any business that's making a good level of profitability, has enough history, and is of sufficient size that you can assess its likely prospects going forward. So it's not really relevant to very early stage businesses. What that gives, that formula, underlying profit times earnings multiple, it gives what we call a cash-free, debt-free valuation, or an enterprise valuation. That is what the shares would be worth if there were no non-trading assets and there's no funding debt. By non-trading assets, the most common non-trading asset is a mountain of cash on the balance sheet that isn't needed for working capital or for the business. Cash that could be taken out by way of dividend, and leaving the business with sufficient cash to run. And we see mountains of cash, and most businesses we're selling, there's absolute mountains of cash in the bank, because it's so painful to take large dividends out because of the penal tax rates on dividends, that many owners of companies just accumulate cash. They take enough out for what they need, and they leave the rest in the company. And it can be quite tax efficient, because at the moment you can get, depending on, as long as we're not dealing with an extreme case, within certain norms, you can get that cash out and the capital gains tax rates when you come to sell your business. Starting then with the underlying profitability, as I said earlier, we usually use EBIT. We sometimes use EBITDA. But if there's a lot of capital expenditure required year on year, so maybe it's production equipment in your business, or I gave the example of a haulage business, if there's always an ongoing capital expenditure need, to use EBITDA and add back the depreciation as part of the profit figure, it ignores the ongoing capital expenditure need and is misleading. And we adjust that operating profit. We want to get to the operating profit that will continue once the business has been sold, what the normal level is. So if there's exceptional income that's not going to reoccur, or exceptional expenses that aren't going to reoccur, we adjust for those. We adjust for a fair cost of management. So we put in what we consider, after talking to the client and taking their view, what we jointly consider is a market rate for the management team. And we'll deduct that and add back what is currently paid to directors, and often the market rate will be a lot higher for the reasons I gave earlier. That doesn't mean to say when we're selling businesses that we won't sometimes argue that you don't need a management team, because the buyer will have sufficient management within their organisation already to manage the business without needing people on site. That can be a cost saving that makes it more attractive to a trade buyer. And we're usually looking at the current level of profitability, the current run rate. So if you've taken on some large clients 6 months ago and you haven't got 12 months in your figures yet, we'll adjust for that. We're looking at the current run rate, because the current run rate is the best indication we have of future profitability. For some clients, they have lumpy businesses and they've got an underlying level of business, but they win large contracts. They maybe span 18 months, then it might be 6-7 months before they win another one that spans 6 months. And where the businesses are lumpy, it's sometimes better to take an average of profitability over a number of years. But for most clients, we'll look at the current run rate and use that as a starting point. We're not ignoring future potential. the current run rate, you could say, well, the future is going to be better than the current run rate. Well, we take that into account in the earnings multiple, which I'm going to talk about on the next slide. So we've now arrived at a level of profitability that we think is a fair indication of what the current profitability is, and we want to apply a multiple to that to get to the cash-free, debt-free valuation. The multiple reflects really two broad categories of factors. Firstly, the growth potential, and secondly, the risks within the business. So growth potential, the stronger the growth, the stronger the certainty of growth potential, strong growth potential will push the multiple higher. Weak or declining expectation on business performance will push the multiple much lower. Risks in the business, high risks, so if the business is 40% dependent on its top customer, or there's key members of staff who are at risk and could leave, or the shareholders who are wanting to retire have the technical knowledge or the key customer contacts, the more risks in the business, the more the multiple will be pushed down, and with less risks, the multiple will go up. And really, it's the combination of growth potential and risks in the business, supplemented by acquisition appetite in the sector, that will together allow a judgment call to be made on what is the correct multiple to use. Well, correct's not the right word because it's a judgment call, but what is an appropriate multiple to use? On this slide, we've listed quality of earnings. So these come into risks and potential, growth potential, really. Recurring revenues, if you've got a good underlying recurring revenues, they're already contractually committed at the start of each year. That will, that's a positive. It gives more certainty on what the current year, next year's turnover is going to be, because it's already partly committed. Barriers to entry that keep out new competitions are helpful. What's the market position of the business? Spread of customers, not just spread of customers in terms of, do you have a good spread? And most businesses in the SME sector may be dependent on the top customer for 15-20% of turnover. The second one might be 10-12%. That's not unusual at all. And we have done deals where they are at 100% with one customer. We often find the best way of selling a business that's 100% with one customer is selling to the management team who understand the risks. And I could talk for quite a while on why that sort of transaction works when it wouldn't work with a third party, but I've not got time to cover that today. But we have sold businesses that are 100% dependent on one customer to trade buyers as well in certain circumstances, but often it's easier to sell to a management team who are dealing day to day with that customer and understand the strength of the relationship between the customer and the company, and are able to take to accept the risk as a manageable risk, rather than a trade buyer is much more likely to see it as a very, very high risk. Growth potential we've talked about, and strength of management again comes back to risks and ability to grow the business. So many of those factors we've listed do affect both the growth and the risks in the business. But eventually a judgment call has to be made as to what is a sensible multiple for that business. And when we're marketing businesses to a number of different potential purchasers, they will take different views. They'll take different views on the underlying profitability, and they'll take different views on what multiple is appropriate. And when there's competition and several offers on the table, they'll revise their estimates and revise the multiple they're using to try and win the deal. There's no, as I said earlier, there's no reliable lookup tables for earnings multiples. There is at least one organization who tries to do it, but the multiples have no relationship to what we see in practice, mainly because reported profitability can be very different to what the true underlying profitability is. So we now get to the enterprise value, or the debt-free, cash-free value. By taking the underlying profitability and applying a multiple, we've got to an enterprise value. That is the value that your shares would be worth if there were no surplus assets, no debt, and we chuck corporation tax in as a debt. is the convention to treat corporation tax liabilities up to the date of completion of the deal as a debt that comes off as a cash debt adjustment. So surplus assets are those. So what you're selling for that initial equation, for that profit times a multiple, you're selling the bag of assets and liabilities needed to run your business, the bag of assets and liabilities needed to generate the profitability. So you don't then go and add the net asset value to that, to the first answer. Those are the bag of assets and liabilities needed to run the business and generate the profitability. What you can now add on, or what you always would add on, is any assets that you've got in the business that aren't needed at all for running the business and generating the profitability. And the most common ones are freehold properties and cash, and probably in third place, yachts, we see on a fairly regular basis. With freehold properties, the way we treat a freehold property is when we're looking at the underlying profitability, we'll knock off a notional rent. So we'll talk to the client, come up with an estimate of what the rent would be if the building was rented from a third party, and treat that as a cost that comes off the underlying profitability before applying the multiple. So the base valuation doesn't include the property at all. We then add on the freehold value of the property. With cash, to the extent you've got cash that isn't needed for working capital, isn't needed to pay corporation tax, is surplus cash, is cash you could take out by way of a dividend without leaving the company with too little cash. That's surplus cash. And there's always discussions with the advisors on both sides as to what the exact figure should be, and there's some negotiation on it. But that surplus cash isn't needed by the business and will get added pound for pound to the purchase price. So our initial profit B multiple gives us a figure. We'd then add on the value of the freehold property because we've already allowed for the rent, and we'd add on the value of surplus cash. We'd knock off any debt, funding debt, and there can be discussions as to which funding debt should come off, but most funding debt would come off the valuation. Sometimes we argue that we've argued in the past, in exceptional circumstances, the invoice finance shouldn't come off. And we, on a fairly regular basis, will argue that hire purchase for a new machine shouldn't come off as debt because the new machine hasn't yet provided the benefits to improve profitability and therefore hasn't been taken account of in the initial calculation, and therefore the debt shouldn't come off. So there's subjectivity all the way through. It's about understanding the business, understanding its potential, understanding the different factors in the business, understanding the debt, and taking a professional view on it, and debating it and negotiating it with the advisors on the other side. You hear often people talk about strategic premium, and there's almost the assumption that if you're selling to a trade buyer, they're going to pay you more than the basic valuation. And certainly when we're selling business, we're looking to try and achieve strategic premiums where we can do. So we're looking for businesses to buy your business who can achieve more profitability out of your business than you can. So your business at the moment is independent, standalone, you've got the resources you've got, and you achieve a certain level of profitability. But if that business is sold to a much larger group, they can sometimes bring significant benefits that allow them to increase the profitability. And that can be, they can sell complementary products or services to your customer base and your products or services to their customer base. It could be manufacturing efficiencies. It could be their sales and marketing presence spans a greater geographical region, and it might be spans an international region. They feel that they could sell your products to many more customers than you're selling to at the moment through their own contacts. There's many reasons as to why a buyer will be able to make a higher level of profitability out of your business than you can do yourself. And that's one of the discussions we have with clients when we're selling their businesses at an early stage. We start debating and discussing with our clients what sort of attributes are ideal in a potential purchaser. What attributes should a potential purchaser have to be able to do more with your business than you can do with it yourself, because of what they bring to the party in respect of their own resources and their own skills and their own contacts and their own experiences. So many trade sale deals, the purchaser will be able to make more profitability. Maybe not tomorrow, it might take a year, might take 2 years, 3 years, but will be able to make more profitability out of the business than if it stays independent and standalone. That doesn't mean to say they wish to pay for that. They see that is their benefit through the resources they bring. But in a competitive situation where we've got a number of offers on the table and we're negotiating those offers and letting purchasers know that we've got higher offers and asking people to improve on their offers, then it does, for the right business, it does come into play, and you can achieve a valuation higher than what it would be worth on an independent standalone basis. And at the moment, we're seeing circumstances where we're getting valuations significantly higher than where we expected them to be for these reasons. Particularly, but always where there's good competition, we've managed to attract a number of potential purchasers who are very keen to acquire the business, and therefore they're sharpening the pencils and putting better offers on the table. Is there a tendency for shareholders, current owners, to overvalue? I think there is, particularly in smaller businesses. I think once businesses get to a turnover of maybe 3, 4, 5 million pounds and upwards, there's less tendency. But in the smaller businesses, I think it's easy to forget that the company is providing more than just a profit stream. It's providing more than just a shareholder return. It's providing jobs for the shareholders who are directors, and often for family members. And therefore, the business is, feeding the whole family. Having a good valuation, having a valuation that you understand the methodology, and you understand the potential for improving the valuation, is the starting point to understanding whether you're overvaluing or not. But we do find, particularly for the smaller businesses, there's sort of an inherent optimism of entrepreneurs, and there's a different risks come into it, a different risk profile. If you've run a business for 20, 30 years, you know the risks, you're comfortable with the risks, you understand the risks, they're fine, they're just manageable, not a problem. But if you were looking yourself at buying an identical business, you'd see the risks differently. From the buyer's perspective, you see the risks as much more risky. And they are more risky because you, in working in the business for many, many years, have built up good relationships with your customers, with your staff. You understand how your production process works. You understand, all elements of the business, and you've got experience. You've made the mistakes in the past and learned from those mistakes. Whereas buyers will know that they haven't got that experience and will price what they're willing to offer accordingly. So just to conclude, before we move on to questions, and please can I encourage you, if you wish to ask a question, use the Q&A. We're happy to answer any question that are asked. Use the Q&A facility that's either the top, bottom, or side of your screen, depending on how you're viewing this webinar. But just in conclusion, we believe evaluations are just an absolute essential tool. Some of the best deals we've done for clients are clients who have sold a business before and then gone on to set up another business and have set that up, the second business, with an eye on the exit. So they've learned from running the first business. They've understood what value they got out of the first business. They understood what purchasers liked, what they didn't like, and they've started again a new business in a different field. And we've taken all the decisions with an eye on the exit. What will it do for the marketability? What will it do for the saleability and value of my business, taking these decisions? A professional business valuation will allow you to understand what your business is likely to be worth, whether there's going to be issues in selling it, and allows you then to take the right decisions in the period up to selling it, and possibly may make you decide you're going to delay selling your business because there's work to do first. You can actually make quite small changes, can have quite a radical difference on your valuation, because you can make changes to your business that affect both the underlying profitability and the multiple. So certain actions can increase your profitability and increase your multiple, and that can have quite a significant effect on the overall valuation. I would totally avoid free valuations. There's plenty of websites that you put in 2 or 3 figures and they'll give you a valuation. They're just absolutely unreliable. There's too much. There's no understanding of your business. There's no professional judgment. They don't even look at cash and debt adjustments. It just gives you a nonsense figure. But valuations for most businesses derive from underlying profitability. In certain sectors, recurring turnover is important. In certain sectors, the freehold property won't be valued separately. It'll be regarded as an integral part of the trade, such as the care home business. We'll get a much higher multiple to reflect the value of the freehold property as well as the business valuation. Don't assume buyers will pay a premium. And valuation is only one part of the picture. It's about how saleable your business is, what can be funded, etc., etc. So really the overall conclusion is if you understand how your business will be valued, you will see opportunities to improve the valuation of your business. And you can make fairly simple changes that affect both the underlying profitability and the multiple, and that then can have quite an impact on your valuation. So how can we help? I talked about the range of services we offer at the start of this webinar. And the services really fall into early stage advice so that clients understand what can be achieved and embark on something that can be delivered. And as part of that, evaluation report is a starting point that many clients choose to go with. And then we've got our lead deal advisory services, taking the client through the transaction from start to finish, advising throughout, and helping get the transaction over the line. The valuation report, as we're highlighting on this slide, it does set out the calculations and methodology in our professional opinion, but it also gives our professional insight, our comments on factors driving and draining the value. And really, the reports are typically 20 pages long and will give you a real good understanding as to how your business will be valued. And we find our valuations are accurate. When we go on to sell businesses that we've done valuations on, yes, we'll always try and beat our valuation. We'll usually be able to beat our valuation, but often we're only beating it by 5-10%. The valuation we've done in the first place is accurate, and ensures that clients have gone into a transaction with the right understanding as to what can be achieved. So at this point, I'm going to ask Catherine to join us, and Catherine's going to host the Q&A facility. I see we've already had a couple of questions, but it's not too late to ask a question if you wish to. Just use the Q&A facility, type in your question, and we'll pick up and answer it in a couple of minutes' time. Hi, Catherine.
Thanks, Andrew. Yeah, the first question we've got is, how long does it normally take us to carry out evaluation, and what kind of information do we need?
I'll start with the information needed, because we put together an information request list, and that's under a page. It's typically 9 or 10 questions, and we'll send that across to the client, and often we'll get asked to send it to the accountant as well, because the accountant might be providing quite a lot of the information. Most of the valuations we do actually come from accountant introductions rather than directly from a trading business. We're asking for things like 3 years annual accounts with trading accounts, where management accounts are available, and if monthly management accounts are available, that's great. We'll ask for at least 24 months. We can see seasonality. We can see, and at the moment, 24 months is quite useful because of spotting the impact of COVID on the business. Having a monthly accounts can be helpful for that. If forecasts or budgets are done, we'll ask for that. We'll ask for details of exceptional income, exceptional charges. We'll ask for an analysis of directors and emoluments so we can assess whether they're paid at market rate. If there's a property involved, we'll ask for details of that. But the starting point really is, if we have a 3 years annual accounts, we can then put together a meaningful information request list. And there's certain questions on the information request list that we then deal with by discussion. So when it comes to discussing the business and its growth prospects and certain matters about the business, we tend to put it on the information request list, but we highlight that we'll do that by discussion rather than expecting that in writing. How long it takes, once we get the information, we can do the report fairly quickly. The thing that often takes the longest time is waiting for the information to come through. And the other thing we ask for is top 10 customers for the last 2 or 3 years, so we can understand the dependence of the business on certain key customers. Everything is clearly totally confidential, and we usually can turn a valuation round within, once we've received all the information we need, it's typically 3 or 4 weeks. If there's a reason for needing it quicker, it can be done quicker, but it's typically 3 or 4 weeks. And we present the report and talk through it, and then make amendments. So it's a reasonably quick process once we get the information we've asked for.
Thanks, Andrew. Quite a topical question next. How are you starting to deal with valuing companies where profitability has been affected over the last couple of years through COVID? Are we taking an average or a weighting? How are we going about those? Thank you.
I think that's a very good question. It's something that we've been discussing ourselves over the last, particularly we started discussing this about a year ago. I think we're fairly comfortable how we do it now. It depends on the business, because every business has been affected differently. What we want to do, what we're interested in, is ongoing future profitability. We're not that, we're interested in how a business performed under COVID, but we almost, for most businesses, want to discount that. We want to know what's the underlying profitability going forward now. So if your business is still badly affected by COVID, probably not the time to sell your business. Maybe not even the time to do a valuation. But for most businesses, it's not, every business is different. So it's about getting under the skin of each business and understanding each business, understanding the impact COVID has had. And clearly certain sectors have been hit really hard by COVID, and other sectors have had an absolute fantastic time and made super profits. Which again need discounting. What we're interested in is what is the ongoing profitability now? What's the future profitability going to look like over the next 6 months, 12 months, 3 years? And we're not finding it difficult for the valuations we've done, to get, with 1 or 2 exceptions, they've been a bit more tricky. But for most businesses, getting under the skin and understanding the impact hasn't been that difficult, because we're not looking to value a business based on what it did during lockdown 1 or lockdown 2. We're wanting to understand what the business is likely to do in terms of profitability over the next few months and next few years. Do you want to add anything on that, Catherine? Because I know you've had a number of valuations where COVID has had an impact.
Yeah, we almost just treated the sort of the COVID period as an exceptional event. And use the time up to that, and then the time after that as more of a reflection of what the underlying performance was. Obviously, if exceptional profits were made, you'd probably see that within the surplus cash. And although interesting, there's some businesses' performance improved as a result of the challenges of COVID. And so in those instances, the COVID impact has been sort of positive going forwards permanently, because they perhaps focused a bit more on efficiencies and sorted out some production issues which they hadn't really got to the bottom of. So every situation's different, and it's really important to understand the normal from the exceptional. The COVID grant income that people would have received and the furlough money that companies would have received, we tend not to be treating that as exceptional, because that, for a lot of companies, that mitigated them taking more drastic decisions on the cost basis. So we often don't adjust for that when we're trying to normalise profits. But yeah, every business is different. And it's just about trying to unpick what happened because of COVID from what's happening now, that we're sort of seeing life returning a bit more to normal.
I think we've had a long enough period since the first lockdown now to look at how our business has performed and how it's performed over the last few months. And it was a difficult issue doing valuations 12 months ago. We're finding it's much easier now, because we've got we've had a lot longer period since the first lockdown. And as Catherine says, the number of clients who have said to us, we furloughed a lot of staff, and then we took quite a few members of staff back, and we found we're running the business. We've still several members of staff furloughed, and found that we didn't actually need the people we had before at the same level to run the business at the same size. So redundancies were made, and the business is now more efficient in making higher levels of profitability. That seems to be a fairly common theme. So I think we've given quite a long answer to that question. It's a relevant question, but for most businesses, we can look at the impact of COVID and assess it, and we've had a long enough period since the first lockdown to form a view as to what the profits are likely to be going forward, because it's the future profits we're interested in, not the past ones. So is there any other questions, Catherine?
No, that's all for now.
I think that COVID one was asked twice, actually, because we had it as a Q&A, and we also had it on the chat facility by a different person, so it's a good question. But thank you for listening. We have recorded today's webinar, so if you've had to nip away and miss part of it, Catherine will email you over the next couple of days with a link to where you can find the webinar on YouTube. Catherine will also send out the PowerPoint, so you've got the PowerPoint slides. And if you would like a discussion, and Catherine will offer you the opportunity to have a chat with us about your business in particular, because we've talked in general terms here. If you'd like a chat as to where we could help, and on no cost, no obligation basis, chat about your business, would welcome the opportunity to do that. So thank you very much for listening. And at that point, I'll bring the webinar to an end. Thank you.
Thank you.